Good morning and welcome to the Killik & Co podcast. This week we've had inflation numbers from the Bank of England which came in at 2.6%, slightly above the Bank of England's inflation target of 2%, but slightly below expectations of 2.9%. If you look at this chart here, you can see how inflation has moved over the last 7 years. If you look at the black line, that shows the headline level of inflation, and the coloured bars underneath show what is causing inflation to rise and fall. If we go back to the start of last year, you can see that inflation was barely above 0%. And then in June we had the EU referendum, and that caused quite a sharp fall in the value of sterling. And now we're having to spend a lot more on the goods and services that we import from abroad. So that's the main reason why inflation has risen over the last year. And for the year 2017, we are expecting an average inflation number of around about 3%. But last month, it was slightly lower than expected. And the reason for that was that the oil price has fallen. So the oil price back in June did go as low as $45 per barrel. That means we're spending less on fuel, and that's why the inflation number for the 12 months to June only came in at 2.6%. We've also had a change in state pension policy this week. So the original plan was to raise the state pension age to 68 in the year 2045. That's now been brought forward by 7 years to the year 2038. And the reason we're having to do that is that we do have an increasing number of people in the UK who are over the state pension age. Now, state pension payments at the moment are paid from the national insurance contributions of people who are currently in work. Our workforce is not really expanding that rapidly, and yet the number of people in retirement who are claiming on the state pension is expanding rapidly. So have a look at these numbers here. 2017, we expect to have 12.4 million people over the state pension age. Moving out to 2042, we expect that figure to rise to 16.9 million. So that's a huge change, and therefore it's not surprising that the government has taken some action to change how the state benefits are claimed. We've also seen quite a sharp rise in the euro this week, and in fact the currency has hit a 2-year high against the dollar. And the reason for this is that we've had some quite positive comments from Mario Draghi, who's the president of the European Central Bank. And he has said that he thinks the period of deflation for Europe is over, and that he feels very positive about growth within the eurozone. So that has caused analysts to expect that perhaps there will be some monetary tightening, possibly higher interest rates over the coming months or years, and that would be good for the euro. Therefore, the euro has risen quite significantly over the last week. The dollar, on the other hand, has been quite weak over the past fortnight, and in fact it has hit a year-to-date low. The reason for that is that people are starting to lose confidence in whether Trump will be able to enact the growth-boosting policies that he did talk about during his campaign. So back in November, he talked about lowering corporate tax, he talked about repealing Obamacare, and he talked about lessening banking regulation. To date, he hasn't really managed to make any progress on any of those, and therefore people are losing confidence in him, and the dollar is weakening. Now, at the moment, it is the second quarter reporting season, so we have had a number of companies reporting over the last couple of weeks. I think a sector of note at the moment is the technology sector, so we have had some good results coming out from the technology sector this week. And actually, the S&P Technology Index has risen to a record high over the last week. And what's interesting is that it has finally risen to the level that it reached before the dot-com crisis back in the year 2000. So if you have a look at this chart here, this part here is where the index reached back in the year 2000. Then we had quite a steep crash following the bursting of the dot-com bubble. And since then, we've had a fairly steady rise up until the current level, which is a record high for the S&P Technology Index. But what's interesting here is that valuations within the sector are considerably lower than they were back in the year 2000. So we're looking at price to earnings ratios here, and that's just a measure of how expensive stocks are. So they compare the price of a stock to the earnings that are being made by the underlying company. The higher the price to earnings ratio, the more expensive we consider that stock to be. Now, at the moment, the average price to earnings ratio for the wider S&P 500 is 19 times, and for the S&P Technology Index, it's 19.4 times. So there's not a huge difference now between the ratio for the technology sector versus the wider market. If we look back to the year 2000, however, the average ratio for the S&P Technology Index was 73 times, which is a huge number. So valuations for tech stocks back then were much, much higher than they are today. Another sector of note this week has been US financials, so we have had a number of the major US banks reporting. Overall, the results have been good and profits and revenues have been higher than expected, but what has been disappointing is the amount of profit that these banks are making from trading. The reason those profits have been slightly disappointing is because market volatility has been quite low in recent months. That means that people aren't trading as much, and therefore the banks are making less money from trading revenues. So have a look at this chart here. This shows the VIX, which is a measure of volatility in the markets. This shows the VIX over the last year, and as you can see, it is much lower than it has been in previous months. Looking forward to the week ahead, we do have lots more companies reporting. We're looking forward to Alphabet, PayPal and Facebook. Also on the healthcare side, we have Merck and AstraZeneca. That's it from us. Have a great weekend and we'll see you next Friday.